You're listening to Peter Lewis's Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Wednesday the 22nd of March. Each weekday morning on Peter Lewis's Money Talk I have the latest business and finance stories for you that affect the Asia Pacific region. In today's headlines, US Treasury Secretary Janet Yellen said yesterday that the Treasury is ready to offer more official support for US banks in a speech that talked up the importance of mid-sized banks in particular. President Xi Jinping was in Moscow yesterday for a second day of talks with President Putin at the Kremlin. President Xi has invited the Russian leader to visit Beijing sometime this year for a return visit. And President Xi described Beijing and Moscow as great neighbouring powers and comprehensive strategic partners. And while President Xi is visiting Moscow, Japanese Prime Minister Fumio Kishida arrived in Ukraine on a surprise trip. He held summit talks with Ukraine's President Volodymyr Zelensky, and he's the first leader of Japan to visit a country in conflict since World War II. Stress in the global financial system, as well as cash hoarding by banks, has sent overnight borrowing costs in Hong Kong surging by the most in 17 years. The overnight Hong Kong interbank offered rate, HIBOR, surged 253 basis points to 4.14% on Tuesday. That's the biggest gain since data was first compiled in 2006. On today's programme, I'm joined by personal wealth advisor Enzio Pfeil and John Schofield, Managing Director at Tempus Investment. With a view from Japan is Nick Smith, Japan strategist at CLSA Tokyo. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. On Wall Street Tuesday, US shares surged, led by regional banks, after Janet Yellen said the government stood ready to provide further support for smaller lenders if needed. The S&P 500 jumped 1.3% to end the day at 4,003 in its first close above the 4,000 threshold since March the 6th. The Dow gained 316 points or 1% to close at 32,561. The Nasdaq Composite added 1.6% to close at 11,860. Shares of First Republic and other regional US banks rallied on Tuesday after Ms Yellen said the situation is stabilising and the US banking system remains sound. The KBW Regional Bank Index surged 4.8%, its biggest gain in over 2 years. Shares of First Republic, which have fallen about 87% this month, rose more than 29%. Leading a broader rally in US lenders. US Bank Core surged almost 9%, Key Core jumped over 9%, and Zions rose 7%. Asia Pacific markets rose on Tuesday. Supporting sentiment during the Asian session was a rebound in additional Tier 1 bonds sold by banks in the Asia Pacific region. Hong Kong shares rebounded from a 3-month low Tuesday. The Hang Seng Index rose 258 points or 1.4% to 19,259. The Hang Seng Tech Index saw a 2.5% gain. On the mainland, the Shanghai Composite was up 0.6% at 3,256. Shares of HSBC, which tumbled over 6% Monday, rebounded by almost 3%. Standard Chartered recovered 2.3% from its Monday losses of 7.3%. And futures markets are pointing to further gains for the Hang Seng at the open this morning of about 130 points. US government debt sold off as yields leapt higher. A day before the Federal Reserve's decision on interest rates, the yield on the policy-sensitive 2-year Treasury climbed 26 basis points to 4.1%. And that's the 9th session in a row that 2-year yields have moved more than 20 basis points in a single day. It's the highest level of bond market volatility on record outside of the 2008 financial crisis. Elsewhere in the markets, the US dollar was slightly weaker and Brent crude oil rallied 2% on Tuesday as risk appetite improved while banking fears eased. And you can get more details on the latest market movements on my daily blog at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
And it's time to welcome our guests. We have with us this morning wealth investment strategist Enzio Pfeil. Morning, Enzio.
Morning to you, Peter.
And also with us is John Schofield, who's Managing Director at Tempus Investment. Morning to you, John.
Hello, good morning, Peter.
Now, as you heard there, US Treasury Secretary Janet Yellen said Tuesday that the Treasury is ready to offer more official support for US banks in a speech that talked up the importance of mid-sized banks. She was speaking to the American Bankers Association and she defended as necessary the steps taken to support Silicon Valley Bank after its collapse earlier this month, following a massive run by its depositors. And she said similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. She said the steps we were taking are not focused on aiding specific banks or classes of banks. And she said our intervention was necessary to protect the broader US banking system. Enzio, is there something fundamentally wrong with the US banking system? Surely a healthy and strong banking system shouldn't need all this government support.
Well, there are two things wrong. It's all about greed and money. The first point being that the bankers at these various unregulated banks, the ones that, not the big eight, but the ones that are below the big eight, are not really regulated as in such a disciplined manner, so they can get away with much more than the big regulated banks that were very strongly regulated as of 2008. And the second point being the greed bit, that it's just greed will always be there. This time, of course, it was that you had 2008 was that you had the derivatives market, these bank mortgage rates, these bank mortgages that had been spread all over the world via derivatives, and then they poorly capitalized banks.
John, what do you think? Have bankers here done something fundamentally wrong? Enzio was talking about lax regulatory and environment. What in particular have bankers done wrong then that caused this?
Yeah, I mean, we get this every 10 years or so. This cycle repeats itself over and over again. You remember things like the savings and loans crisis. I think that was the late 80s and then late 90s, and we had the Asian banking crisis and so on. So it beggars belief, really, that supposedly sensible bankers are once again been borrowing short and lending long at minuscule interest rates, taking advantage of the bond market bubble created by the Fed. And it's as simple as that. On the broader question of regulation, you remember in 2008 we had too big to fail, so all the big banks have been, the regulation system has been sorted out. As mentioned, we don't hear anything about the savings and loans these days. I imagine that situation is also stable. So we've got, they've neglected to regulate properly these mid-sized regional banks, and now that's going to be addressed. So I suppose you could say that that's what needs to be done.
And Janet Yellen is talking about extending this scheme that in effect bailed out depositors at Silicon Valley Bank and Signature Bank to basically cover all banks. Now, is that the right thing to do? Doesn't that just increase moral hazard? Because then what is the incentive, first of all, to people care about where they put their money? And secondly, what's the incentive for the banks to care about what they do with your money?
Well, I think the important thing is what happens to, shareholders, really. This is a problem of management at the banks and shareholders, sadly. I think in Silicon Valley lost all their money. The shares are worthless. So that's as it should be. I think it's the right thing to say. You have to sort of say that to stop a panic, stop contagion, because individual depositors have no ability to assess the risk of a particular bank.
What we don't know is what's going on backstage with the lobbyists in Capitol Hill, and it just seems to me as if there's going to be a lot of tug-of-war game playing going on there between how these smaller banks are regulated and what the lobbying groups say, especially in the run-up to that presidential election, the 5th of November, 2024.
The Treasury is talking about extending this loan to all deposits. How do they afford that? I mean, the FDIC, which guarantees bank deposits, has about $125 billion on its banking balance sheet. It has about $100 billion line of credit, but the US banking system is about $22 trillion. So the FDIC assets only cover about 1.25% of deposits. Surely there is no way, is there, that they can afford to guarantee the deposits of more than 2 or 3 banks at any one time?
Yes, I understand there's going to be some sort of special levy or tax on the whole banking system.
It'll have to be a big one
to top up the insurance, but that's one thing. The other thing is, again, the Fed plays a role in this. I've been watching closely the evolution of the Fed's, the balance sheet of the Federal Reserve, and it's been coming down till last week. It's coming down steadily by the prescribed amount from QT, or reversal of QE, and the allowing their holdings of treasuries to run off, to mature. And but suddenly last week the balance sheet ticked up again, but it's not because of the QT, it's because of this new liquidity facility that's been created to finance the banks that appear to be having liquidity issues. So that was I can't remember, it was 30, 40, 50 billion and so on. So you might see more of that, might see more of it coming onto the Fed's balance sheet, or back onto the Fed balance sheet.
These are all non-sticky band-aids.
In what sense? In that they're not really solving the fundamental problem?
They're not solving the fundamental problem of really regulating the shadow banks in America. And until that is attacked, we're going to see this cycle happen time and time again. And we haven't even talked about regulation of the crypto markets yet.
Well, that's another topic in itself, isn't it? You think there's some problems there lurking?
I think I don't want to be an expert on it because I don't know anything about it. It's just too arcane. But I'm sure that this whole FTX thing was just the tip of the iceberg.
Now, John, you mentioned that shareholders got wiped out in Silicon Valley Bank, Signature Bank. Of course, that didn't quite happen for the case of Credit Suisse. We're in the rather bizarre position where certain bondholders got wiped out, but shareholders get $3.25 billion.
I can't remember what the market value of Credit Suisse was before. I suspect that's a pretty token amount. But yes, I mean.
But why are they getting anything even?
Politics.
Right.
To make the deal work, you have to kind of. And the Saudis can't be very happy. They're 10% shareholding of Credit Suisse.
And people are not happy out here.
Completed with.
Because people out here are not happy because private banks have sold quite a lot of these bonds to sort of wealthy investors in Asia.
Yes. Absolutely.
Well, let's move on to the Fed. The Fed is going to conclude its meeting today. Futures markets are pointing to about a 90% chance of a 25 basis point rate hike, maybe 10% chance of nothing at all. What do you think? Should the Fed carry on raising rates in this environment?
I think, they should stay the course. I mean, it's been working. I mean, since they finally had this Damascene conversion that they had to get inflation back under control, it's starting to work. So why stop now? They plotted a clear course, so we were going to go to 5 or 5.25 federal funds rate, and then see, and they should just continue with that. I mean, we've seen, I say it is working really. We've seen bubble after bubble burst, but without any major impact on the economy, the real economy. As you know, we still have strong employment in the US, and no sign of this recession. And maybe the recession is going to come later in the year, but there's no reason to take their foot off the pedal right now. Particularly as it would send entirely the wrong signals. Okay, the bankers have screwed up again. We're going to let them off the hook. No. So no, I think they should just keep on the same course. We've had a lot of noise, on and off. Every time something happens, the usual suspects jump up and down and say, you've got to pause, you've got to start cutting rates, otherwise we're going to have a massive recession, etc., etc. And they've been proved wrong time and time again. So there's a lot of noise around this, but the actual direction of the Fed has been very, very clear and very steady for now since middle of last year.
I think what's happening is that the traders are betting that the rates will peak this year and start getting cut. The analysts think they will continue going up. I continue maintaining they will go up to about 6% on the Fed funds rate. But I find this dichotomy very interesting in the market. I don't know whether the traders might just be building a big short position because they know that it won't happen. I don't know how that works on the inside these days.
If the Fed carries on raising rates, isn't something going to break in the markets? I mean, we've already seen...
It's already breaking.
Yeah, well, that's what I mean. We're seeing this already, aren't we? If they carry on raising rates, aren't we going to head for like some Minsky moment in the markets where everything just topples over the waterfall?
I think that once you see the debt ceiling debate begin in earnest in May, June of this year, ahead of the presidential elections, I think once you see the housing starts falter even more, the wages rise even more, not because of, in my mind, I would respectfully differ with John, not because of strong labor markets, just because many people don't want the job. They just don't want to work. So it's a supply side issue, which is riddling the inflation equation considerably. So I myself think that the inflation problem is very much 40% a supply side issue, oil, gas, war, weather, things like this, people not wanting to work, and you can't do the Fed policy can't affect that. Having said that, the Fed, as John says, I agree, must stay the course because it's really lost all credibility anyway.
John, is something going to break? I mean, Enzio's been saying for a while, haven't you, that you think rates are going to get to 6%. If they got to 6%, can the markets cope? Yeah. Can the bond markets cope with rates at 6%?
Short answer, yeah. Well, of course, no one knows, but I think so. As I say, we've seen several bubbles already break. The crypto bubble, the commodity prices. Commodity prices are falling quite quickly now. I think oil and gas are going to keep on falling. So there's some disinflation coming from that source. But I mean, the bond market, the Treasury market, long end of the bond market, is still predicting a recession with yields of only 3.5%. Is recessionary. So, but the other thing I wanted to point out is that the volatility in the stock market is quite interesting. Has actually stayed within quite a narrow range. We haven't seen the sort of big, the VIX spike up, and I think it spiked up to 25.
Which is not that high, really, is it?
Which is not high. It's within the range. Once you get above 30 is the kind of ceiling, and it ticked out. This week it's ticked back down again.
I just wanted to add one other inflationary motor, which it took me a couple of years to figure this one out. It's called catch-up inflation. In other words, with these companies having done so poorly for 3 years because they've been whacked by COVID, it's time to try and jack up the prices as quickly and as much as they can, on top of which, of course, airlines have to circumvent the war zones, so that drives up their fuel costs. And so those are other things that the Fed simply cannot do anything about.
But are equities next, do you think? John was mentioning the VIX. It's at a reasonable range, but look at bond market volatility. It's at record levels. We're seeing moves of 20 basis points a day in the 2-year yield. We've seen it, I think, every day now for the last 9 days. Are equities next?
The earnings outlook is going to look chunkier and chunkier. A harbinger of this is really the slowdown in housing investment. You're seeing more and more headlines of firings coming through at Meta, at Amazon, at groups like that. These are big employers, and I just think that the structural recession, I've forecast sort of a stagflation of sorts a couple of years ago already. In other words, relatively 4% inflation and very little, if any, growth. And I still stick with that forecast because I think that just because it hasn't happened yet doesn't mean it won't happen. I believe that the structural forces are making it. It's a slow burn recession that we're going to go into.
John, do you think we're heading for a recession?
Well, so far it's been sector by sector.
Yes.
And
Good.
we're starting to see some sectors recover already. So we had a massive, the tech sectors, the semiconductor index in particular is outperforming massively now, having had a very large correction last year. So the mantra of rotation, sector rotation in the markets, you see now that everyone was chasing value because they were chasing yield last year, and that's now been flipped over, and we're seeing some of these value sectors, obviously banking, but also energy, in particular, with underperforming and selling off, while the technology, from a long-term point of view, people could see that the future is in these new technologies, whether it's electric vehicles, advanced semiconductors, AI, biotech, etc. So that sort of area is now starting to get attention again.
Well, thank you both very much for your thoughts this morning. Very interesting discussion there. You heard John Schofield, who is Managing Director at Tempus Investment. Wealth management strategist Enzio von Pfeil was also with us.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Time now to go over to Tokyo, and we talk with Nick Smith, who is Japan strategist at CLSA in Tokyo. Morning, Nick.
Good morning to you. Congratulations on the new format.
Thank you very much. Very nice to talk to you once again. Well, it's been a dramatic week to start this new podcast with everything going on in the banking sector. In the Asian markets, it seems to be Japan that's been hit the hardest in terms of its banking stocks. Why is that?
Well, I think if you watch the way that banking stocks perform, they're highly correlated with and very sensitive to movements in the Japanese 10-year rate. So really what's going on is nothing to do with fears about whether Japanese banking stocks are going to fall apart, but much more questions about whether the incoming governor, Ueda, is going to allow rates to rise soon or later. And I think the feeling amongst people just immediately when SVB and UBS hit was that'll give him an excuse to hold off. I don't believe that he needs an excuse. I believe that Ueda is minded to get rid of yield curve control before the end of June.
Right. And of course, the issue has been for banks that they can't get any yield on Japanese bonds. So they've been buying US treasuries instead, which are the very things that have been declining very fast in value as the Fed raises rates. But I presume Japanese banks, they're large, they're well capitalized. This is not going to cause the same problem for them as we've seen in some of the smaller US banks.
No, I don't think that that's a particular issue. I mean, actually, if you look at what's been going on with the holdings of U.S. treasuries, they've been selling foreign bonds all the way through last year. And there's a very good reason for that, is that the hedging costs are so high. So actually, after hedging costs, 3-month hedging costs, you get a minus 1.8% yield on U.S. treasuries at the moment. So fortunately, that pushed them out of U.S. treasuries quite a while back.
So if you think that the new governor of the Bank of Japan is going to get rid of yield curve control, you think maybe that the Fed is close to getting to a peak in rates as well. What should you do in Japan? What should you be buying?
Well, I think if you look at all of the sector's correlation with and sensitivity to changes in rates, then it's the banks that broadly for some of the megas, a 1 basis point move in 10-year rates is 1% on the share price with a very high correlation. So if you think that Japan's going to take out the yield curve control and let rates drift upwards, then you buy the banks. If you think the reverse, then you do the reverse. My belief is that what the BOJ is doing is unsustainable, although I do understand people at the moment are very nervous about it, and there was a time when people were actually talking about the Fed actually cutting rates today rather than raising them. I think that they'll be disappointed if they're counting on that.
And is there a problem in Japan with these AT1 bonds that we've seen with Credit Suisse, where those bondholders got wiped out? We know that there are quite a lot of wealthy investors around Asia who invest in these because of the high yields on them that you can get, maybe 9-10%. But that's what's happened to Credit Suisse seems to have changed the whole outlook and rationale for that market now.
That's true. My understanding is that the exposure is small. I'm not a banks analyst, but my understanding is the exposure is very small.
And so is the crisis coming to an end now? Have regulators around the world done enough? We heard Janet Yellen last night talking about maybe guaranteeing more bank deposits if necessary, giving the impression that the US was going to step behind all of its banks, although it raises the question of how it can afford to do that. But do you think we're near the end of the crisis now, or are there other things brewing?
Obviously, the CDS rates suggest that there are still considerable concerns over banks around the world. My belief is that what the US is going to do is guarantee as much as it can, try and bring down concerns about this, freeing up the hand of the Fed to do the right thing and try and rein in inflation before it loses this battle. So do remember that the Fed was late on raising rates, which is why we've got the high inflation so entrenched. Otherwise, we're going to end up with a situation where inflation globally is stronger for longer. My belief is that the rise in wages in Japan is way above where the expectations had been. And I think that we may well end up with a stronger for longer for inflation in Japan also.
And tell me a little bit about those annual wage discussions that go on in Japan for listeners who maybe aren't familiar with it. These are the Shunto wage negotiations, aren't they? Can you explain a little bit about that?
Yeah, I mean, obviously spring is the beginning of the new fiscal year. This is the only time that you need to be watching wages in Japan. Otherwise, it's bonus season, but that's relatively small. I think the expectations have been pretty low at the beginning of the year. The expectations were only say 2.5% for wage negotiations. As of Friday, they're about 3%. And then on Friday, the Japan Trade Union Confederation came out with numbers saying the first update on this, with I can't remember 650 unions reporting, was a 3.8% increase in wages. So way above. Just remember that Kuroda, the outgoing governor of the Bank of Japan, had said we would need 3% in order to start considering mission accomplished. Well, we're way above that. It might come down a little as the later union numbers come through, but I think that it's going to be harder to justify the Bank of Japan's present forecast of 1.6% inflation, which is a lot less than half of where inflation is at the moment, however much the government tries to manipulate it with subsidies.
Nick, it's always a pleasure. Thank you very much indeed. That's Nick Smith, who is Japan strategist at CLSA in Tokyo. Thank you very much for listening this morning. There's plenty more business and finance information on my daily blog. Take a look at peterlewismoneytalk.substack.com. I'll be back tomorrow with another episode of Peter Lewis's Money Talk. Tomorrow will be Fed Day. Joining me to discuss the latest moves by the US Federal Reserve will be Andrew Ferris, CEO of Econosis Advisory, and Vandana Hari, founder of Vanda Insights. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. See you tomorrow. Bye for now.
Money Talk